Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
All right, welcome in everyone, kicking off another deep dive here.
Indeed.
And today we're tackling something that's pretty front of mind for a lot of businesses right now, right?
Absolutely.
It's corporate finance in a high interest rate environment.
Yeah.
So you shared some really interesting resources with me, looking at, how companies are responding to this kind of new reality.
Right.
Some really sharp strategic thinking for finance professionals, folks like yourself, and really some frameworks for thinking about how to navigate these higher rates.
Yeah.
So our goal today is to, I think, really dig into the sort of meat of the strategic implications here.
Right.
Understanding how companies are adapting their approaches and really what that means for the work that you do every day.
Yeah. It really is a pivotal moment, and grasping these changes is far from just theoretical. It directly shapes the decisions that are being made across all facets of corporate finance. What's particularly interesting to me is just how interest rates ripple through so many core elements of a business.
Okay. Yeah, let's start with the basics, but let's go a bit deeper.
Okay.
Like, why are interest rates so critical in corporate finance?
Right.
Most people probably just think of them as, the cost of borrowing money, right?
Yeah.
I'm taking out a loan and, I've got to pay this interest rate.
That's the immediate impact, certainly, but the effect is much broader.
Okay.
Interest rates are a fundamental component of a company's cost of capital.
Right.
Essentially, the return a company needs to generate on its investments to satisfy its investors and lenders.
Yeah.
And this cost of capital is a key input in crucial decisions like company valuation and determining if a capital project makes financial sense through capital budgeting.
So it's not just that loans become more expensive. Higher interest rates actually raise the bar for what qualifies as a worthwhile investment for a company.
Exactly. Higher rates mean borrowing is more costly, no doubt.
Right.
But they also influence what returns investors expect.
Oh, okay.
In a higher interest rate environment, investors might demand greater returns, which in turn increases the overall hurdle rate, the minimum acceptable rate of return for new projects.
Got it.
So a project with an IRR that looked promising when interest rates were low might no longer clear that higher hurdle.
Right.
And that leads to a really key question, how do companies accustomed to over a decade of inexpensive capital adjust to this new landscape?
Yeah. I mean, it really does feel like a turning point for some sectors in particular.
Right.
The sources mentioned real estate investment firms and high-growth tech companies.
Yes.
What are some of the pressures that they're likely to face that are maybe unique to their industries?
It's intriguing that both of these seemingly disparate sectors can encounter similar challenges.
Right.
Real estate firms often rely heavily on debt financing for their projects.
Right.
Refinancing that debt at significantly higher rates can severely compress their profit margins.
Right.
For high-growth tech companies, many of their valuations were built on projections of future earnings, discounted back to the present using lower rates.
Makes sense.
When discount rates rise, those future earnings become less valuable in today's terms, potentially making previously attractive expansion plans less appealing based on their IRR and NPV analysis.
Right.
Yeah.
It's like the fundamental math of investment gets recalibrated.
Exactly.
When you shift the interest rate environment.
Right.
Okay, so let's shift gears a bit now and talk about how this impacts a company's capital structure.
Okay.
That blend of debt and equity that they use for funding.
Precisely. As the cost of debt increases, companies naturally reassess that debt-equity mix. You generally observe a move towards more conservative capital structures during these periods.
And what does that mean in a more practical sense? Like, what does a more conservative capital structure look like?
Typically, it involves reducing the reliance on debt. Companies might prioritize using internally generated funds for investments instead of borrowing.
Got it.
We could also see some considering equity raises, despite the potential dilution for existing shareholders, as a way to strengthen their balance sheets and decrease their debt burden.
Okay.
And so if we link this to the bigger picture, it's about enhancing financial stability.
Right.
Taking steps to fortify the business.
Yeah, the example of Ford Motor Company and the materials was really interesting.
Yeah.
Even after strategically refinancing debt during low interest periods, they're now really emphasizing cash preservation and minimizing their exposure to variable rate debt.
Yes.
That seems like a very forward-thinking strategy.
Absolutely. Even well-managed companies are taking extra precautions.
Right.
The focus on reducing variable rate debt is crucial because those interest payments can fluctuate with market rates,
Right.
adding greater uncertainty in a high-rate environment.
Yeah, okay, so companies are being more cautious about taking on debt, and they're being more selective about their investments.
Yes.
But what are some of the specific tools that corporate finance teams have available to them to actively manage the interest rate risk that they're facing?
This is where proactive risk management becomes essential.
Yeah.
The resources you shared point to several key strategies. One of the most vital is hedging using financial derivatives,
Okay.
such as interest rate swaps.
All right, so let's unpack that a little bit.
Okay.
Interest rate swaps, I think for a lot of folks that might sound a little bit complex.
Sure.
Can you break down what the core idea is there?
Think of it this way. If a company has a loan where the interest rate fluctuates with the market,
Okay.
a variable or floating rate loan,
Right.
they can enter into a swap agreement with another party,
Okay.
often a financial institution.
Mm-hmm.
The company agrees to pay a fixed interest rate to this counterparty.
Got it.
And in return, the counterparty covers their variable interest payments on the loan. The underlying amount on which the interest is calculated is called the notional amount.
Mm-hmm.
Effectively, it's a way to transform a floating rate liability into a fixed rate one,
Yeah.
offering protection against rising interest rates.
So it gives you some predictability.
Exactly.
Got it.
Right.
Yeah, that makes a lot of sense.
So, in a volatile interest rate environment, that can be incredibly valuable,
For sure. For sure.
to have that stability.
The sources also mentioned locking in debt at longer terms
Yes.
and building detailed scenario models.
Right.
How do those strategies play into managing risk?
Locking in debt at fixed interest rates for longer durations achieves a similar outcome to interest rate swaps' predictability of payments.
Got it.
By having a larger portion of their debt at a fixed rate,
Mm-hmm.
companies are less susceptible to future increases in interest rates.
Okay.
And developing comprehensive scenario models within FP&A is crucial for understanding the potential financial impacts under various interest rate conditions.
Yeah.
This allows companies to stress test their financial forecasts and prepare for a range of possibilities.
Makes sense, yeah.
It's about being prepared.
The Starbucks example of utilizing interest rate swaps was really interesting
Yes.
to see how that actually plays out.
Very sleuth.
Like, it's not just this theoretical concept. Companies are actually employing these tools.
Right.
And the point about accurate cash flow forecasting seems particularly critical in this environment.
Absolutely. In a high-rate environment, having a clear understanding of the timing of your cash inflows and outflows becomes even more critical
Yeah,
to ensure you can meet your debt obligations and avoid any liquidity issues.
that makes sense.
Precise cash flow forecasting is fundamental to all effective interest rate risk management strategies.
Okay, so it seems like there are a lot of demands being placed on FP&A and Treasury teams.
Yeah.
What are some of the shifts that you're seeing in their roles and responsibilities in this kind of new landscape?
You've highlighted a key shift. FP&A and Treasury functions are increasingly taking on a central and strategic role within organizations.
Yeah,
We're seeing a greater emphasis on rigorous stress testing of financial forecasts,
right.
specifically analyzing various interest rate scenarios.
Got it.
This goes beyond simply creating a best-case forecast.
Yeah,
It involves understanding the sensitivities and potential vulnerabilities under different rate environments.
so it's not just about crunching the numbers and looking at the spreadsheet. It's about really thinking through the different possibilities.
Exactly. It's about being proactive rather than reactive.
Yeah, and the communication aspect must be more important than ever.
Yes.
These teams need to be able to clearly communicate the risks and opportunities associated with different funding strategies.
Yes.
To, executive leadership, to the board of directors.
Precisely. Enhanced communication is paramount.
Yeah.
Finance teams need to be able to articulate funding strategies. The rationale behind hedging decisions and the potential impact of interest rate movements in a clear and understandable manner to stakeholders across the organization,
Yeah.
not just those with a finance background.
Right, right.
Furthermore, the sources underscore the importance of stronger collaboration between FP&A and Treasury, effectively managing a company's debt portfolio and mitigating interest rate risk requires these two functions to be tightly integrated.
It sounds like the role of these teams is evolving from, you know, primarily reporting historical data
Yes.
to more proactively providing insights
Yes.
that, can inform critical business decisions.
Exactly. It's a transition from a more reactive stance to a proactive and strategic one.
Yeah.
They need to be thinking several steps ahead,
Right.
considering the long-term cost implications of current decisions and how fluctuations in interest rates could impact the business's trajectory.
So for those of you listening in, as you navigate your own responsibilities in corporate finance, what are some of the key takeaways that we've discussed today in this high interest rate environment?
What's truly insightful is that the strategies we've discussed, disciplined capital allocation,
Right.
active risk management through hedging and prudent bet structuring,
Mm-hmm.
these aren't just abstract concepts relevant to large corporations.
Right.
They offer valuable lessons that you can apply within your own sphere of influence,
Yeah.
regardless of the size of your organization.
I think that's a really important point.
It's about adapting these principles to your specific context,
Yeah.
understanding how these shifts affect not only borrowing costs, but the entire financial strategy provides a much deeper comprehension of the current economic climate.
It really does underscore this renewed emphasis on efficiency and strategic financial planning.
Absolutely. It's a consistent theme throughout all of this.
Yeah, and I think, considering how that renewed focus might impact your own work
Right.
and how you can contribute to your organization's resilience in this environment is a key consideration.
This prompts an important question for you to ponder. How can you contribute to more robust scenario planning within your team?
Yeah.
How can you foster clearer communication about interest rate risks with your colleagues and stakeholders?
Yeah.
And what potential opportunities might emerge in this environment for companies that are well prepared and agile? That, I believe, is a critical area for further reflection and exploration.
Excellent. Well, this has been a fantastic conversation, really insightful.
Thank you.
Appreciate you taking the time to share your expertise.
My pleasure.
And for everyone listening in, thanks for joining us for another deep dive.
Indeed.
We'll catch you next time.
Sounds great.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.